Alrighty, so in today's video I've got a treat for you because today's video is on the ultimate guide to trading options profitably even if you're just starting out. So for many people, when they first get into the world of options, it can be pretty intimidating, right? There are so many things to learn, there are so many moving parts, so many concepts, and many of them, because of that, they get confused. So with this video, I'm going to try and break down just the core essentials, the core elements that you really need to understand in order to be profitable. And guess what? There's really no need to learn every single thing about options. It's good to know, but when it comes to just profiting or trading on a day-to-day basis, there's just a few core fundamentals that you really need to understand to be consistently profitable. So that's what I aim to do with this video, and it's going to be a pretty long video, so I've broken it down to two parts. So what you want to do is take lots of notes, right? Bring out your pen and paper, take out your notebooks, and just write as many things as possible, or just go through this video over and over again. All right, so I'm going to go starting off with the basic fundamentals. So if you're new to options, you can definitely learn a lot from here as well. So let's begin off with the very core fundamentals, and it's basically everything you need to know about call and put options, right? So let's start off with the call options. So a call option is basically a contract that gives the option buyer the right to buy an underlying stock at a specified price, which is also known as the strike price, within a specified time period, which basically means before expiration, right? So every option contract has an expiration date, right? So you can choose the expiration date based on your own trading strategy or trading style. So for example, let's say you buy a call option at the strike price of $108 with an expiration date at 31st March 2023 for $1, right? So basically this call is above the current price of the market, right? So right now the price is $103.50. So for this example, you're buying the call option above here, which is 108. So if you're paying $1 for this contract, basically what you're doing is you're paying out $100 in terms of capital, right? You're putting up for this trade. That's because each option contract controls 100 shares, right? So if you have 100 shares for one contract, you have to times it by 100. So if it's $1, you times 100, that is $100. And if it's $2, you times that by 100 as well, that becomes $200. Okay, so here's an example. So let's say you buy a call option at the strike price of $108 with an expiration date at 31st March 23 for $1, right? So this is the current price right now, which is $103.51. And then you speculate, you think that the market will really go up, right? So you decided to buy the $108 strike price for this call option, and you pay $1 for it. Now, each option contract controls 100 shares. So when the option says that it's worth $1, what you're essentially paying for this when you're buying the option is $1 times 100, right? So the total will be $100. So let's say, for example, if the option costs $2, then you take $2 times 100 shares, that will be $200. So this is basically what you have to put up in terms of your capital to buy this call option. So how do you know whether you're going to be profitable on this call option? So for simplicity's sake, let's talk about whether you'll be profitable at expiration. So at expiration, in order for your call option to be making money, it basically has to be above this strike price of $108 plus whatever you paid for it, right? So in this case, you paid $1 for it. So what it has to be above is $108 plus $1, which is equals to 109. So in order for you to be profitable on this call option at expiration, it has to be above $109. Anything that is below $109, you'll be in a loss, right? And your maximum loss is kept to just $100 because this is pretty much what you paid for it when you're buying the call option, right? So even though if the stock goes all the way to zero, the most you can lose is $100. So when you're long a call, you have the right to buy the underlying stock at the strike price if you exercise it before expiration, right? So what does exercising mean? So exercising basically just means to get long the underlying stock, right? So for example, down here, let's say you have the strike price of $108. Let's say the market goes all the way up to $112 and there's not many days left to expiration, and you're thinking that the market could go further up and you really want to hold this stock for the long term. So instead of holding this call option, Now, what you want to do is you exercise it, which means to say now you'll be buying 100 shares at $108. So in this way, your option will be gone, and then now you'll be holding the shares, right? You'll get 100 shares per contract at the strike price which you chosen, and of course you have to put up the capital for it. So in this case, $108 times 100, that'll be $10,800 that you have to put up to be holding these 100 shares. Now the moment once you exercise it, you'll be in profit already, because assuming the price is $112, you would have bought the shares at $108, and that means your profit is essentially the difference between these two, right? Of course, you paid $100 for that already, so you have to deduct that off, and that'll be your profit essentially. So if you hold on to it, the market goes further up, then you can make even more. Or there's also a risk whereby if you hold on to it and the market comes back down, then it's possible for you to break even or even lose money if the market goes further down. But basically, exercising just means to get hold of the shares. Now, this is if you're long a call. Now, what if you're short a call? That means you take the other side. So if you're short a call, now you have the obligation to sell the underlying stock at the strike price if you're assigned on it. So when you're long a call, you can choose, right? You want to exercise it, you don't want to exercise it, it's up to you. But if you're short a call, you do not have that choice, because the moment the buyer of the call option, which you sold to, decides to exercise this option, then guess what? You will have to sell the stock to them, right? So if you already have the shares, then basically the broker will just remove all your shares and then pass it over to the other person, right? So they will sell off your shares if you have. Now, what happens if you do not have the shares already? If you do not have the shares, then guess what? You'll be basically just short selling the shares, right? So let's say, for example, it's the XYZ. So your broker will just basically show a minus 100 beside it, right? So it shows that you're minus 100 shares. Let's say, for example, if you assign on one option contract. All right, now let's move on to the put option. Now, the put option is where the option buyer have the right to sell an underlying stock at a specified price, which is the strike price, within a specified time period, which is also before expiration. So here's an example. So let's say you buy a put option at the strike price of 100 with an expiration date at 31st March 23 for $1, right? So in this case, again, same thing, times 100 shares, this will be worth $100, right? So in this case, when people buy a put option, it's usually as a form of protection, right? As a form of insurance. So maybe, for example, you already have 100 shares on this stock, so you're afraid that the market might crash. So as a way to protect your maximum loss, some people would just buy, let's say you buy a put option at 100 strike price. So this way, if the market really crashes anywhere below $100, you know for a fact that you'll be kept to a maximum loss of $100 plus, of course, whatever you paid for it, right? So in this case, if you bought a put option, this is your protection. Now, what if you're just buying the put option in terms of speculation, right? You do not have any shares. So how do you know whether you're in profit? So the put option in this case, for you to be profitable, the market has to be below the strike price minus the debit which you paid for it, right? So in this case, it'll be 100 minus $1, which is equals to $99. So in order for you to make money on the put option, the stock price has to be below $99 at expiration. Anything above $99, you will be in a loss. Again, maximum loss will be whatever you paid for it, which is $100. So if you're long a put, you have the right to sell the underlying stock at the strike price if you exercise it before expiration, right? So for example, if you already have 100 shares and let's say it crashes all the way to maybe $0, right? If it crashes all the way down, well, you have the option to basically just exercise your put option, and then your shares will be sold off at $100 instead of wherever the current price of the market is. So this way, your loss has been kept to $100. Now, what if you are taking the other side of the put option? So if you're short a put option, now you have the obligation to buy the underlying stock at the strike price if you're assigned on it, right? So in this case, if the person decides to exercise the put option, so he'll be selling his shares, then guess what? You have the obligation to buy those shares, and now you'll be long 100 shares at the strike price of $100, right? So in this case, there's two things you can do at this point. If you are still bullish on the stock, you can pretty much hold on to the shares, but if you're no longer bullish on it, then you have to just sell it off immediately once you get those shares. Alright, so the next topic is about moneyness, right? You have ITM, ATM, and OTM. What does this mean? Right, so ITM stands for in the money. Right, so a call option is considered in the money when the stock price is above the strike price. So as you can see down here, the strike price is $100 and the current price is $103.51. So in this case, anything that's above this call option strike price is considered in the money. On the other hand, for the put option, it is considered in the money when the stock price is below the strike price. So this is your strike price, so anything below this strike price is considered in the money. Now next is at the money, right? So an at the money is very simple. It's basically a call and put option is considered at the money when the stock price is basically at the strike price, right? Anyway, around here, you basically just consider it at the money. And finally, OTM stands for out of the money, right? So a call option is considered out of the money when the stock price is below the strike price. So anything below here, the call option, this is considered out of the money, and it's out of the money basically because when it reaches expiration and it's not in the money, then guess what, there is no value in this call option whatsoever, so this call option basically expires worthless. Likewise, for the put option, anything that is above this put option strike price is considered out of the money. So anything that is above here, so let's say for example at 103.51 at expiration, then guess what, the put option expires worthless. There's no value left in this put option. Okay, so the next important thing to understand is intrinsic and extrinsic value. This is a very important concept for you to understand, so you really want to pay a lot of attention down here. So every option contract before expiration has either intrinsic plus extrinsic value or just extrinsic value, right? There is no option that is just only intrinsic value because there's still time value left. So intrinsic value is the value of the option if exercised today. Now, if the option is in the money, regardless whether it's at expiration or before expiration, there is always intrinsic value, and if the option is out of the money, there is zero intrinsic value. So let's take this example down here, this put option. So let's say the current stock price just goes down to $98, right? It doesn't matter when, right? So if it goes down to $98 and your put option down here is $100, the strike price, which means to say your put option is $2 in the money. So if it's $2 in the money, there is $2 of intrinsic value, right? So if it goes all the way to $95, so that is $5 below the strike price of 100, then guess what? Then there is $5 in terms of intrinsic value. Next is extrinsic value. Now, extrinsic value is also known as the time value of the option. So all options have extrinsic value as long as it hasn't expired, no matter how deep in the money it is, right? And at expiration, all extrinsic value goes to zero. So I want you to take a look at this option chain down here. So as you can see down here, there are two columns for the call and two columns for the put options, right? So this is intrinsic and extrinsic, and intrinsic and extrinsic. So intrinsic basically comes down to how much it is in the money, right? So you can see down here the current price is $95.42. So remember, for the call option, for it to be in the money, the current price has to be above the strike price. So let's say the strike price of $95. So you can see that the current price is above the strike price of $95, which means to say it is in the money. How much is it in the money? It's in the money by 42 cents. So as you can see down here, it exactly matches the intrinsic value shown on this option chain down here. Similarly, for this is $5.42, because if you're using the strike of $90, then 95.42 is $5.42 in the money. So that's why you have the intrinsic value of $5.42. Similarly, for the put option, is basically how much it's in the money. Again, if it's $100 for your strike price and the current price is $95.42, that means it's below your strike price, it's in the money, right? So how much is it in the money? It's $4.58 in the money. You basically just take 100 minus off 95.42. Now anything below 95.42, you can see the intrinsic value is zero. Similarly, for the call option, anything that is below the strike price, which means to say it's out of the money, there is no intrinsic value whatsoever. Next is extrinsic value. So extrinsic value, one thing you have to understand is that it actually gets more when it's near at the money, and it tapers off when it's further out of the money or further in the money. So as you can see on both ends, you can see it's much lesser than when it's somewhere around at the money, right? So how extrinsic value is calculated basically comes down to price of the stock, where it is, right? Is it near the at the money, and also how much time there is left on the option. So the important difference to understand between intrinsic value and extrinsic value is that at expiration, all extrinsic value will always go to zero, right? There is no value whatsoever for the extrinsic value when the option has expired. But whereas for intrinsic value, this doesn't change, right? Intrinsic value is basically how much in the money the option is, regardless whether it has expired or not. So this doesn't go away at expiration. Okay, next, let's talk about the option Greeks, right? So the option Greeks, there are a number of them, so I will just touch on what I feel is the most important ones where you really need to understand. So let's get into the quick and dirty Greek, starting off with delta. So the definition of delta is the theoretical estimate of how much an option's value may change given a $1 move up or down in the underlying security. Right, so let's go back to this option chain. You can take a look at the delta column down here. So you can see it ranges from 0.90 to 0.19. So the range of a delta is from 0 all the way to 1.00. So the way we would call this out, if it's 0.9, we would just call it as 90 deltas. And if 0.42, we would just call it as 42 deltas. So how the delta relates to the option price is basically when the underlying stock moves by $1, then this option price will move by the delta amount. So in this case, it will move by 90 cents. So for this option down here, for this strike price 100, an underlying move of the stock of $1, then this option price will basically move by 42 cents. So one thing you'll notice is that as the option is deeper in the money, the delta will get higher, right? But as it moves out of the money, the delta gets lesser, right? So when the option is very deep in the money, it can go very close to 1.0. So at this point, it basically is like emulating the stock movement, right? It's because a dollar move in the underlying stock is also a dollar change in the option pricing. But on the other hand, right, if you have the delta that's very low, that means it's less sensitive to the price movement of the stock. So even though if the stock moves $1, you can see the option pricing only moves by 0.19 cents. Now the other way which we use delta is as a rough estimate of the probability of the option being in the money. So a 20 delta option has an approximately 20% chance of being in the money at expiration, which also means that if you are short the option, it has an 80% chance of being in a profit, right? Because for a short option, what we want is for it to expire out of the money at expiration. So let's take a look down here at the put options. So you can see down here, they have 7 deltas. So 7 deltas just means that this has a 93% win rate, right? So this is a very high win rate option if you were to sell the put option at a 75 strike price, but the trade-off is that you have very little premium. On the other hand, if you were to go all the way down here, you notice it's 0.89. That means if you were to sell the option, you have an 11% chance of winning, right? Because it's already in the money. As a short option seller, you want the price of the stock to be out of the money at expiration. So in this case, although they're giving you a lot of a premium, it is mostly intrinsic value because it's already in the money. So in order for you to actually profit on this option, the current stock price have to move out of the money by expiration in order for you to really profit on this premium which you receive up front. And next we have theta. So theta measures the rate at which the option loses its time value, which is the extrinsic value, as the expiration date draws near. So just imagine you're holding an ice cream cone, right? So imagine you're holding an ice cream cone during the summer. So the ice cream will melt very, very quickly. So until the point that there's no more ice cream left and it's all that's left is your ice cream cone. So basically theta measures the rate at how fast this ice cream is actually melting. Right? So if you were to go to this option chain down here, you will take a look at this is the column of theta. You'll see that there's a number down here. So the number basically just tells you how much you are making or losing on a daily basis, depending whether you are long or short the option, right? So if you are long the option, then this theta number means that you are losing this amount of money on a daily basis, right? 0.04 means you are losing $4 every single day because each option controls 100 shares. Now, if you are short the option, it just means that you are making this amount every single day until the extrinsic value finally goes to zero. Now, the other thing you will notice is that the theta is highest where it's around at the money, right? And then it tapers off when it's deep in the money and when it's far out of the money. And you notice this actually coincides with the value of the extrinsic value. And that's because, right, if the extrinsic value is the highest, then of course the theta is going to be much more because there's much more to decay of the value, and there's much lesser to decay as it's further out on the other end. So as an option seller, the theta is working for you, and as an option buyer, the theta is working against you. Next, we have gamma. So the definition of gamma is the rate of change in an option's delta per 1 point move in the underlying asset's price. So this is also what's commonly known as the delta's delta. Now, the important thing about gamma is that the bigger the gamma, the more your position is sensitive to direction. So if you are an option seller, as much as possible, we want to keep the gamma small, because if the gamma is too big, it can threaten any profits that you have already made on your trade. But on the other hand, if you are long the options, then you may want to have the gamma as big as possible, because this way, if you have the move in the right direction of your long option, then in this case, you're going to be able to make much more. And finally, we have Vega. So Vega measures an option sensitivity to implied volatility. It is a change in the option's price for a 1 point change in implied volatility. So basically, when you are long an option, then you are pretty much long Vega, which means you're long volatility. You want the volatility to increase. This way, it will increase the price of your options, where you can sell it off for a higher price than when you first bought it. But if you are short options, you are basically short volatility, and that means you want the volatility to drop, right? Because when you sell the options, let's say for example, you sell it for $1, then as much as possible you want the volatility to drop, because when the volatility drops, guess what? The premium also quickly drops as well. Because remember, when you're selling option, most of the time we sell extrinsic value, and extrinsic value has got to do a lot with implied volatility. So the bigger or the higher the implied volatility, the juicier the extrinsic value. When the lower the implied volatility, that means the extrinsic value is lesser as well. So when you sell it when the implied volatility is high, and then when the implied volatility drops, suddenly you will see that the premium will drop quite a lot, right? So ideally, we want this premium, when we sell it for $1, we want to buy it back or let it expire basically at $0. So this way, we will receive the full premium which we got up front. Now, of all the Greeks down here, there's only one Greek that we really need to monitor on a daily basis. To me, this is, I feel, is the most important Greek. The rest is, I don't really monitor as much. So basically, the one that you monitor the most is delta. And this is something that you will use pretty much on a daily basis. Alright, so now we are getting to the exciting part, and this is what I consider the #1 secret to trading options profitably, right? So this is the reason why there can be an edge when it comes to trading options, and if you really understand this, you really grasp this, then you'll be able to trade options really consistently, profitably in the long run, right? So what is this #1 secret? Well, the #1 secret is basically the concept or the term expected move, right? So what is the expected move? If you're not familiar with what this is basically the amount that a stock is expected to go up or down from its current price by a certain time based on its current level of implied volatility. So in other words, its range, right? How high and how low the stock can go by a certain period of time. Now, there is a whole formula for you to use to calculate this expected move, but the good news is that there is no need for you to calculate this yourself, because it's already given to you on a silver platter, right? So if you were to just open up your option chain from your trading platform, this number is given to you on the right hand side of this option chain, which is corresponding to the date of expiration for the different options, right? So for this, let's take a look at the 24th February, where there's 24 days to expiration. So you will see that there's 26.7%. So this is the implied volatility. And on the right hand side, it translates this implied volatility to the actual dollar move of the underlying stock. So let's say, for example, that the stock right now is $100. So how do you know what is the expected range, right? The expected move. Basically, you can see it says plus minus 16.05. So let's just round it off to $16. So what it means is that on the upper hand, on the up hand side, the range would be 116, and on the bottom side, it will be 100 minus 16, which is 84. So this from 116 to 84 would be considered the expected move, or the range of the stock that it's likely to trade within in the next 24 days. All right. So if you were to take a look at the further days to expiration, the 136 days to expiration left, you'll notice that the number is much bigger, because it makes sense, right? Because if there's more days left, then of course the stock has more room for it to move. So this is what you call the expected move. Now, in itself, this is not really a secret, right? Of course, the mathematical model just tells us roughly what is the range that it can be. But the secret sauce actually lies in this, which is that the historical statistics have shown that the IV usually overstates the actual volatility. That means that prices tend to stay within the expected move more often than the probability suggests, right? So when it comes to trading options, you don't necessarily have to trade it directionally, right? So for example, if you think the market is going up, then you trade the bullish option strategy, or if you think the market is going down, you trade the bearish strategy. When it comes to options, you actually can trade a neutral trading strategy. That means to say you can trade it in a range. For example, you have the strategy called the strangle or the iron condor, which means to say that if the market actually stays within this range by expiration, then you'll be in profit. And if it exceeds this range, let's say it exceeds 116 or below 84 at expiration, then you will lose money, right? So this is one way that you can trade the market. So based on the theoretical probability, the percentage-wise that it actually should stay inside this range is 68%, which means to say 68% of the time you'll be winning, and then 32% of the time you will be losing, right? So with all else being equal, there is this efficient market hypothesis. That means to say if you trade this long enough, at the end of the day, it should be equals to zero, right? All your winners and all your losers will be net equal to zero based on the winners and the losers that you have, right? So there should be no edge whatsoever. But the reality is that there actually is an edge, because although the theoretical probability suggests that it actually stays within this range 68% of the time, the actual occurrences within this range is actually much higher. So as you can see, is 85% for the expected move formula, and based on 16 delta options is 71%. So this is a study that's been done over, I think, a sample size of over 10 to 20 years. So this is a very statistically very relevant study, because it has a lot of data points inside. So that means to say that although you're supposed to win 68% of the time, instead you are actually winning roughly 71% all the way to, what is that, 85% of the time. So now suddenly there is no longer this $0 net at the end of the day, because now you are not winning just 68% of the time, you're actually winning much more. So this is where suddenly you can have an edge, where you will now be in a profit, right? You will have a positive amount, be it $1 or even just $2 or more, right? So this is where you can have the edge. And the best way I can give you an analogy is using this. Now, I know this may not necessarily be the best example, but it is the best that I can think of that can get the point across so that you really understand this. So, for example, you want to go and buy a shoe for your child, right? So I have a son that is almost 8 years old. His feet is going pretty quickly, so we have to actually buy shoes for him pretty often, right? So whenever we want to buy shoes for him, right, you want to measure the shoe size. So let's say, for example, if his feet is roughly this size, we want to buy a shoe size that can fit him would be this size, right? So it matches exactly the size of his feet, right? So for this shoe, let's say it costs $10, right? But as you know, because a child's feet is always growing, right, we do not always want to buy the same size as his feet. We always want to buy it slightly bigger. So we will want to buy a slightly bigger so his feet can kind of grow into it. So instead of buying the shoe which matches or fits the size of his feet exactly, which costs $10, we have to buy a bigger shoe. So this bigger shoe, all else being equal, because it takes up more material, right? So naturally, the cost will be more. So let's just say the cost is $12. So what I'm trying to say here, so you see, my son's feet size is this. So by right, I should be paying $10. But because I want to buy a bigger size, I have to pay $12. Now let's flip it over to the shoe seller. So the shoe seller, by right, should only receive $10 because he should be selling a shoe size that fits nicely to my son's feet, which is $10. But instead, he's selling the shoe that is bigger for $12. So he's actually making $2 more than he actually should based on my son's feet size. So in a sense, this is basically pretty much like the expected range, right? So imagine this is where the market is, right? The market actually moves this range, right? So this is the actual market's range. And this is the implied volatility, right? Because the implied volatility always overstates what the actual move of the market is. So instead of supposedly getting only $10 that fits the actual range of the market's movement, you're actually getting $12 in terms of premium, right, as an option seller. So let's say you think about it this way. Would you rather be an option buyer or an option seller, right? An option buyer, you're actually paying more than what you actually should be paying, right? Because the market only moves this much, but you're paying much more for it. But as an option seller, you're actually getting much more in terms of premium than what you actually should. So that is why there's an edge when it comes to selling options because of this expected move, right? The implied volatility overstates the actual volatility most of the time. So if you were to take a look at this table down here, it shows the spiders, right? So this is a study done by Tasty Trade. Basically, they measured the average realized move, that means the actual move that the index ETF has made, compared to the expected move that is being suggested based on the implied volatility. And they even broken it down based on the implied volatility rank, right? That basically just measures, you know, how high the volatility is compared to previously. So as you can see, in all implied volatility ranges, the expected move still overstates the average realized move. So as you can see, in all instances, the expected move is much more than the realized move, but the expected move is significantly much more than the realized move, much more pronounced when the volatility is extremely high. As you can see, this is almost a $10 difference in terms of the expected move compared to what the market actually moved. Right? In lower volatility, it's roughly only about $5 plus. So that means there is actually much more edge when you put on a trade to trade the expected move when the volatility is much higher. So trading the expected move means to trade the edge where the implied volatility overstates the realized volatility, because this is where you get more premium than you actually should. So that is why premium sellers always have an edge over premium buyers. Alright guys, so that's it for part 1 of this video. I hope you've liked this video. If you have, please give me a thumbs up and also subscribe to my channel. And by the way, if you haven't already gotten your free copy of the Options Income Blueprint, then you can do so at optionswithdavis.com/blueprint. So basically, in this blueprint, I share with you the top 3 option strategies that can help you generate a consistent income every single month, just trading only a few hours a day or even a week. Alright guys, so I will see you in part 2.